growth of almost 27%, and the asset quality has also improved, so IRDA is looking pretty good. GSPL negative news flow, look at that, 20% knockdown on GSPL this morning as PNGRB has cut tariffs in its HP pipeline. So GSPL is seeing a huge cut this morning. And JSW Energy, I'm looking at that one. JSW Neo has gotten an order to set up a 700 megawatt solar power project from NTPC. So that stock is up almost about 2.5%. So I must say, very dramatic reactions to individual stocks and overall good performance for the market. Nigel, over to you.
That's right, Sonia. The Nifty is holding above that 20 DMA. So that's pretty good news. From the high of the day, though, it's come off close on 60 points from the first tick of the day. That's par for the course. Stocks that are reacting to numbers. You have Bansali Engineering. Well, that came out with a rather good set of numbers after a couple of quarters, I think. So that stock, in fact, is up close to around 3.5%. One of the top volume traded stocks. IRDA as well looking quite good. So that stock is up more than 10% as you speak. There's limited float on that one. So that stock moves up as well. JMR Power, I think there was a large trade that Nimesh was highlighting to us about. So that one, post that large trade, the stock has opened up with a gain of close to around 5%. I think it's in that 5% band. So it's up close to 5% as we speak. GSPL, as Sonia mentioned, it's down close to around 20%. A couple of stocks are reacting to technical news flow. Case in point being Hindustan Copper as well as Nalco. Both of them have come out of the FNO ban. Everyone's waiting by for this super metal cycle. So that's the other tailwind that they have. So both those two stocks are higher because of a technical factor. They've come out of the FNO ban after a few trading sessions. So both those two moving higher and moving higher on large volumes. HPCL as well as BPCL. Remember, on Friday's trading session, they were a little bit nervous. What if geopolitical issues blow up? And that's what could make crude oil prices move up. And for the next couple of months, we're unlikely to have any kind of a price increase because of elections here. Now, crude oil prices have cooled off actually over the weekend to around $87 per barrel. They were around $91 per barrel on Friday. Explains why some of these OMCs as well are running along. So a good looking screen. The Nifty is holding at around the 20 DMA. You would like it to build on from here on. For the time being, the Nifty Bank as well is participating, holding around 47,900 odd.
Well, some more stocks then. If you can have a few more volume-led gainers right now. We've got Senco, which is starting up higher, and it's such a huge outperformer. Senco. Okay, I think it crossed over into 4 digits. I think it did, then maybe fell a little bit, but 4% higher. Look at the volumes there for this point in the day. Bajaj Electricals is starting up with a 5% pop. Stocks at about, I think, 270, and that'll. Okay, I think, sorry, that's a different name, but this is 950. PTC, I think we mentioned that, is looking good with volumes. Solara is another one, which for this point in the day, in the morning, right at the word go, comes up with large volumes. Ujjivan is another one, which starts with a 5.5% pop, 580 on that one. Transformers and rectifiers, what else but higher, another 5%. So 6 months, 10x, that one, TRIL. And just a big mover, decent volumes as well. Premier Explosives has been doing well last week. I think it had a good one. Another 7% this morning. So this is, some of the stuff which is coming up with some momentum right now. Exicom on the way down, perhaps. We mentioned GSPL, of course. There's news there. We spoke with PNGRB, but the other one is Exicom, which is up 6.5%. Motherson is another one which is down 4%. So 122, and it's got decent sized volumes. I think we already mentioned RK Forgings, which is down about 5% or so. But that's largely sort of news and sentiment related stuff which is working through the markets right now. 22,260 is where we're at, about 120 points higher right now. Ravi Dharamshi is market master of the day. He's the Chief Investment Officer, Value Quest Investment Advisors. Ravi, good morning. Good to have you with us here. Thanks very much for your time. Prashant this side. Ravi, we are in election season. It's a long election cycle, and all the way into June. I know you're not the one for very near-term kind of outlook, etc. But that's, I guess, top of mind for many. How is the market going to find its way through into the next a couple of months at least? Just any thoughts that you have and how you're thinking about things.
Thank you, Prashant, for that. I think it is really important that you put that in the context that we think from 3 to 5 years perspective, and sometimes not focus on next 2-3 months, something that we do. We probably miss out on a 5% market move because we are always looking 3 years, 5 years out. However, we tend to when we have 3 to 5 years outlook,
Okay, I think Ravi, just hold your thought. I think the audio is not very clear. It's dipping and coming up again. So we'll just try and fix that audio, Ravi. And I'll come back to you when I get the green signal, but I'll just wait for that. The market, by the way, is up 130 points and it's looking good. By the way, I think GSPL is down
20%.
Is down 20%. Yeah. So limit down.
I just want to point out one stock, Trent, which is at a fresh high this morning. This has been one of the strongest stocks, right? Trent. So it's at 4,220, and that's almost a 40% gain that we've seen in Trent this year, just in 2024. And of course, we all know the story of Zudio, etc., and the way that that brand has performed. But overall, this entire consumption piece has been looking very good, especially some of these names like Trent. The other stock which has hit a fresh 52-week high this morning is Bharti Airtel. So just keep an eye out on that as well. Bharti Airtel too is up almost 25% this year. So big moves coming into many of the telecom names. In fact, 52-week high galore. There's M&M, which is at a fresh 52-week high. Just Dial is at a fresh high as well this morning, and a couple of others. Motilal Oswal sitting at a fresh high. Force Motors, I mean, that stock is up 160% this year. It's really been charging on all fronts. And Thermax is something that is at a fresh high. So there's no dearth of good ideas in the market.
Well, that's right, Sonia. I know a few stocks that are actually moving around. Vodafone Idea, I think today is when the FPO closes, if I'm not mistaken. That stock is down close to around 5% as we speak. It's falling on large volumes as well. So keep an eye out on that one. Some of these cement names as well, little under the weather. You have JK Cement that's down close to around 2.5%. Remember, it's been one of the big outperformers because you're getting volume growth out there, the focus on profitability as well. But for today's trading session, that's a little under pressure. Indus Towers has been a big performer in the last 45 days or so. They're banking on Vodafone Idea surviving and pulling through a next couple of years at least. But that one is coming for some profit taking today. And another one that's on your radar, Samvardhan Motherson. I think, Sonia, you were highlighting that as well. That stock is lower in trade. But Voltas, guys, very hot over the weekend. I was at Vijay Sales as well, because I was shopping over there. But, there was a lot of lines, a lot of, crowd out there. And it's extremely hot.
Although I thought last couple of days it's gotten a little better, no? I mean, the evening...
Is it just me, or is this one of the hottest years we've ever faced?
I think it's the hottest.
We say this every year, but I think this year is really bad.
Because we still have May. Normally it gets very hot in May, but now towards the end of April itself, I mean, not even at the end of April, we still have close to 10 days to go.
And almost 40 degrees every day.
Almost 40 degrees, really hot.
That's hot. And some of the people in villages must also be escaping the heat outside.
You come and cool off for a bit and then leave.
Absolutely. I mean, 100 points right now on the Nifty. The market's losing a bit of ground. We are 120, 130 odd points. We were 120, 130 points higher. Now 100 there on the index. And, Hindustan Copper will come up on your screen. 6% pop. That's a big one. Hindustan Copper is the second biggest volume traded gainer. You flip that and look at the volumes. Humongous for this point in the day. So that's come out of nowhere and suddenly it's occupied the second spot there. With volumes and gains right now.
There's just that technical factor that we pointed out earlier as well, coming out of the F&O ban. So fresh positions getting taken in Hindustan Copper. And coupled with that, there's the stock that we're going to be in this metal bull cycle. So that's why.
Yeah, you need copper, lots of it. Ravi is with us, and I think he'd agree about the importance of copper. He's been a big backer of renewable energy, and we'll talk about that. But Ravi, sorry, we lost you there. Audio problems, but please, if you could start at the beginning. Go on.
Yeah, sure. No, thanks, Prashant. Thanks for putting that in context. See, we tend to think 3 to 5 years out, and we tend to sometimes miss out on the 2-3 months move. But we also would like to, kind of at least identify if there is a large enough move coming on the index or the market. Finally, long term is made up of short term, so we don't want to miss out on that. So clearly, election is the event that is lined up, but I don't think that's an event that is going to give a very large move on either side. Market has been anticipating. The probability is that the event is likely to pan out positively for the market. Even in that scenario, I don't see markets reacting in a major positive way immediately post the election. Yes, it will continue to be a positive, but market has been kind of factoring that in going in. So I don't think that election is a reason for markets to move more than 5-7%.
Okay.
Ravi, since we are on the topic of election, and I know, of course, we'll know when we know, but do you think, 320 to 350 seats for the BJP, I mean, that kind of number is in the price? Only for the BJP?
See, I have no way of knowing what kind of number is factored in, but what I can tell you is as long as the current dispensation is coming back, even if it is with reduced seats or more seats, it doesn't really matter. All that is good for TV debate. But from market's perspective, what we are looking for is policy continuity, political stability. As long as both those scenarios are not hampered, I don't see any major reaction in the market.
All right, by the way, the market is doing really well. 100 points higher now on the Nifty, holding on firmly above the 22,200 mark. And the best part is the broader market momentum. Just look at that. The mid-cap index is up almost 500 points. And that's a big move this morning. Ravi, hi, welcome to the show. You know, we've been chatting all along, right, in the last many months about how this is a stock picker's market. But now at this point, what are the sectors or stocks or themes that look good to go for the slightly medium term to you?
Yeah, so since post-COVID, actually, we have been focused on more domestic-focused sectors, more rather than export-oriented sectors. And also within domestic-oriented sectors, we were focused more on cyclicals, capital goods, auto, maybe financials. Those were the kind of sectors that were likely to do well. And I think even at this juncture, this particular thematics is likely to continue for some more time. I don't see exports reviving in a big way or rural consumption reviving in a big way yet. But that is the area. The disconnect in the market is what is known is already factored in, and what is not known, the fundamentals are not yet improving.
Hi, Ravi. Good morning and good to see you. And I wanted your view on two sectors. You know, the verdict out there is pretty much split. On chemicals, how are you all placed? You all have a liking for the specialty chemicals companies, which is well known. And also on pharma, that's been the big outperforming sector. You know, we're talking about a lot of other themes that are playing out. Pharma, quietly, it's been moving up. 2024, it's the big outperformer.
So chemicals and pharma both fall in the category of sectors that have not done well for the last 3-4 years. And hence the opportunity has arisen over here. However, what I would like to say is that top-down sector view might not be the correct way to look at it, and more bottom-up stock picking in these sectors is what we should do. See, chemicals had a fantastic run from 2014 to 21, and that was a macro call of China +1, and everything kind of benefited. China put production cuts and India put tariff barriers, so that kind of helped the players over here. But now now it is that particular trade is done. Now it is focused on which company has the ability to compete with Chinese or is not competing with Chinese, and which is the real specialty chemicals. Those kind of companies are likely to benefit going forward. So no doubt valuations have become much more reasonable and opportunity exists, but it will still be a bottom-up stock picker rather than a sectoral call. Similarly, in the pharma also, as I have always discussed in the past, in pharma also, there are various buckets. You know, oral solid export-oriented generics are unlikely to do well. There is a cyclical uptick over there because the pricing pressure is reducing. But what we do prefer now going forward is stock-specific, company-specific companies that have strength in an area where where the competitive intensity is on the lower side, valuations are a little reasonable, and that's how we are focusing on it. It's not a top-down call on pharma or chemicals, but it's more a bottom-up stock picking in these sectors.
Ravi, could you talk to us about sort of one or two ideas? I mean, just to sort of explain the thesis behind how you're thinking about some of these things, because as you said, I mean, that a bit about China, the companies which are perhaps competing well or not facing off against China. I mean, just to sort of make clear the thinking on some of these issues, if you can talk to us through some of these ideas, one or two ideas that you perhaps have liked and are liking right now.
So, sure. So I'll give a sense of the framework that we use in terms of evaluating. Will not be able to speak any particular company specific, but what we do like is a company that is focused on a niche area and has the ability to expand in the adjacencies, not directly competing with the Chinese companies, especially on the mass scale or something. For example, commodity companies where there are no trade barriers are going to be susceptible to very sharp cycle on the upside as well as on the downside. Those are the kind of companies that we would like to avoid. However, there are companies which might look small in their particular scheme of things, even within chemicals, there are various baskets. So the particular basket that we do like is the pharma intermediates. Because see, India is a large base of API companies and formulation companies. What we lack is the intermediate and key starting raw material, which is where China dominates. So if we can find a company which is kind of a niche in the pharma intermediate space, because the end customer is all in India, and where the market size is not yet so large that the Chinese are supplying to that space. That is the kind of framework that we look at to identify niche plays in chemical or pharma space.
Okay, there's one thing I wanted to discuss with you, Ravi, and that was what's happening with the tech layoffs, right? There are large layoffs happening globally from global tech giants. Even in India, the situation in the tech industry is not that great, with average salaries not increasing for a while, etc. Do you think all of this will impact consumption or demand over the near to medium term? Is that a valid concern?
Yeah, so first I'll give my views on the technology, or rather, I don't consider them as technology companies. They are more technology service provider companies. So essentially, we outsourced IT servicing is what we do. That particular business model has matured. See, we had a great run for the last 25 years. The companies have gone up to create some of the best wealth in this country, and clearly that is feeding into the consumption as well. Because these are all migrant laborers that move from maybe the tier 2, 3 towns to some of the cities like Bangalore, Pune, and that gives a boost to the consumption, to the real estate over there. It's been a large factor, but going forward, I think their importance in the overall basket of consumption should reduce. And manufacturing as a sector is picking up, capital goods cycle is picking up. Real estate is only doing well at the premium end of the segment right now, not at the bottom. Affordable housing is not doing that well. So to summarize what I'm trying to say is that, yes, at this point of time, IT remains a big contributing factor to the real estate cycle, especially within the consumption. Also, I'm talking about the real estate. It's a big impact. However, going forward, it will reduce. In fact, if you look at some of the other sectors, the pay increase, the kind of shortage of people on the manufacturing side has been far, far more severe. So that gives you an indication of which way the wind is blowing. Manufacturing sector is picking up in India. In the non-IT services part, actually, that is doing quite well. So there are other services which are not really IT oriented. They are doing quite well. So hopefully we will be able to replace the demand impact from the IT services by some other sectors, and overall it might not be so much of an impact.
Okay, I have one final question before we let you go, because this is the next discussion. So I just wanted to lead into that, right? Elon Musk has postponed his trip to India. So there are, of course, a lot of problems happening with Tesla globally, with the fall in sales, etc. So the view is that Tesla may push forward their entry into India as well. For a stock like Tata Motors, which has been doing phenomenally well, do you think this could impact them positively, or is that too simplistic an assumption?
I won't be able to comment on a particular company, but what I can say is we all should be looking forward to entry of Tesla into India. I think it will give a boost to an entire new ecosystem that, yes, Tesla already has like 7-8 suppliers from India where they are procuring some or the other parts. But and Tesla overall EV might be slowing down elsewhere, but I think India has a market, the EV get to pick up. So it's a sunrise sector, and entry of a giant like Tesla is going to give a boost to a lot of the ecosystem, auto component ecosystem over here. From the perspective of competitive intensity, I think it's in a state of flux. A lot of new EV variant will come to the market. There will be a lot of new launches. And over the next 5-7 years, we can expect the EV passenger vehicle percentage in the markets to go up by maybe somewhere between 10 and 20% to by in 7-8 years. So that will put pressure on the incumbents and the ICE vehicles for sure. So, but I am not yet willing to say who will be the winners or who will be the losers in that. One thing is for sure, EV as a trend is here to stay, and it will the penetration levels will rise.
Okay, well, that's a very interesting way of looking at it. And that's the common narrative, right? Tesla's entry into India will broaden the ecosystem, will provide jobs, will provide work for a lot of auto ancillary players. So in general, the entire ecosystem will grow. But thanks a lot for that, Ravi. In fact, we have this discussion. We'll carry that forward now. As you know, Elon Musk has postponed his trip to India, citing very heavy Tesla obligations. Remember, Tesla has now laid off over 14,000 employees, which is 10% of the global workforce, including top executives. And they've talked about the reason for this is cost reduction. So with Tesla doing this, what does all of this mean for the Indian EV ecosystem? And are we staring at a two-pronged issue? One, falling sales, and two, a threat from Chinese players like BYD, which is an issue that Tesla is also facing. Jay Kale of Elara Capital is joining in, and in a bit we'll get another player of this ecosystem. Jay, thanks a lot for joining in. You know, Tesla raises, what's happening with Tesla raises a larger issue, that of a global EV slowdown. And we've seen that in some form play out in our own market as well. I mean, EV passenger vehicle penetration is barely 2.5%. Your thoughts on how all of this could, move forward from here?
Yeah, good morning, Sonia. Yes, definitely globally, if you see, the EV penetration has to a certain extent, EV growth has to a certain extent slowed down. But nonetheless, if you see CY23, the global EV penetration, PHEV and BEVs including, is around 15.8%, which had moved up from 13%. So the pace of growth has moderated, but the penetration increases story is still going on in terms of EVs globally. If I have to talk of India, yes, currently, like you mentioned, we are at a very small 2% EV penetration in India. And one main thing is that we don't have as many models for EVs, meaningful models for EVs, barring 2 years. And in the next 1 year, we are expecting to see many players entering into the space, be it incremental models from Mahindra, Maruti, Hyundai, all these players. So as far as India goes, EV penetration is only expected to increase from here. Our assumption is by FY30, we are expecting EV penetration closer to around 15%. So that is definitely much higher than 2% that we are currently at. And that will be led by incremental new model launches. The issues of charging infrastructure, etc., still remain, and that will progressively get sorted.
Okay, so it's interesting. You're saying that the EV penetration is expected to increase from 2.5% currently in the passenger vehicle space to 15% by FY30. And a large reason for lower demand is because there are just not enough models, not enough launches in the EV market in India. Got it. But, the question that I was asking Ravi Dharamshi a while back, the fact that Tesla is sort of delaying their visit, Elon Musk delaying his visit, Tesla perhaps pushing forward their plans as well. Do you think that is a positive for players like Tata Motors, or is it too simplistic an assumption?
I think it would be too simple. Any which ways Tesla coming into India was not, in a meaningful way in terms of manufacturing, was not going to happen in the next 1 or 2 years. Of course, we know the EV policy over the next 3 to 5 years. They would be setting up manufacturing capacities, if at all, in India. Prior to that, there will be more of imports restricted to around 8,000 units per annum. So I think we have to look at this space from a longer term perspective rather than a next 1 or 2 year perspective. And Tesla coming to India, if at all and whenever it happens, it is going to be a positive for the overall ecosystem. Wherever Tesla has gone, it has increased the penetration levels of EVs in that country, because the overall ecosystem, the awareness around EVs, the charging infrastructure that gets developed around it is a positive for the overall EV ecosystem. And one needs to look at how this pans out over the next 3 to 5 years rather than next 6 to 8 months, even if there is any delay in Tesla coming to India.
Okay, got it. I want to talk about Chinese automakers and the big threat there, right? Understandably, Chinese automakers are a big threat to the auto industry in the US, that is the EV industry there. But is it fair to assume that China is a big threat to India as well? I mean, I was looking at some data, right? The price gap has widened considerably. The average retail price of an EV car in China is now less than half the price seen both in Europe and the US. What does this mean for a market like India?
I think Chinese are, something that we really need to watch out for from a global perspective. Also, I think Chinese have the potential to disrupt many of the global EV makers as well. And we've seen that them trying to enter into Europe, US. Of course, there are a lot of tariffs on Chinese players. In India, that's something that we need to watch out for. Definitely, government has put on hold the Chinese investments of BYD. We've seen reports of that as well. Chinese EV ecosystem is well established. The cost structures are much more competitive than the global players. Their technological innovation on manufacturing of EVs is far ahead than many of the other global players. So definitely that's something to watch out for. And if it enters India, it can definitely make a big impact. Buying the brand aspiration of Chinese players is something that is yet to get established in India. But one needs to see how the political scenario plays out as well, because how Chinese enter India, whether it's into partnership, because probably they may not be able to enter on a standalone basis, is something that needs to be seen. But definitely there's something Chinese players are yet to be, are keenly watched out for in terms of competitive scenario.
Okay, let's also talk about stocks before we head to the next guest, because at the end of the day, for our viewers, that's what matters. A quick comment there, Jay. You were saying that a lot of new participants now entering with, not new participants, but a lot of new launches expected in the next 1 year from the likes of M&M, etc. Tata Motors is the top player in the market right now. Which is the next, competitor that could give a strong competition to Tata Motors in this space? Because stocks like M&M, etc., are already sitting at fresh 52-week highs. Do you think they can build on to these gains?
Yeah, I think, new launches that are expected, apart from Tata Motors, which already have a decent enough of models in India, the next leg of new launches is expected to come out from M&M. The next year, probably we'll also see Maruti. We'll also see Hyundai, Kia. So, the top 5 players of the passenger vehicle industry in India, only one of them has a meaningful presence in EVs in India. And I think over the next 12 to 18 months, you'll see the other 4 also incrementally coming with EV launches. So I think this space is expected to get heated up, currently at very low penetration levels, but expected to move up going forward with incremental launches.
Okay, so on M&M, what is your target price, and on Tata Motors as well?
Yeah, so we have a positive rating both on M&M and Tata Motors currently, and we'll be reviewing our target prices closer to the earnings season.
Okay, we have Anil Srivastava now, the former principal advisor at Niti Aayog, joining in. Mr. Srivastava, thanks a lot for joining in. I just want to understand from your end, what is the impact that the new incentives provided by the government would have on the EV ecosystem? Because as we were just discussing with Mr. Kale as well, the EV penetration, despite everything, is still so low at barely 3%, right, in the passenger vehicle space. What has been done so far which could help increase penetration, and what more do you think needs to be done on this front?
Good morning. Well, the penetration is as per our expected lines. The EVs are picking up pretty well and pretty fast, and that's what was expected by the government when we had started making projections in 2017 about the 2030 and further from there. So it's moving in the right direction, and I'm very happy to see as to what we were planning. The events have started unfolding in the right direction. Now, the incentives have played a very critical role. The FAME 2, which we drafted, it's played an important role in promoting the EVs in the two-wheelers and the three-wheeler segment. And from there, I think we have now started moving towards the personal vehicle segment. Now, what more needs to be done is that the government has been extremely proactive in taking forward this electric vehicle movement. But along with that, now the government has to move forward even faster. And one very critical thing is the standardization, which is very much needed. And that is probably will give a lot of consolation and a lot of relief to the buyers, in the sense that you have to have the standardizations in terms of the batteries, in terms of the charging protocols, and so that the swapping policy, which has been not announced after being introduced, but it is not finalized, that may also take shape, number one. Number two, the Indian buyer is very circumspect, and I still feel that there's tremendous scope for having an appropriate vehicle for the Indian buyer and the Indian segment. And that is very much needed. We need to have a vehicle, yes, in the upper segment. Yes, there are models which are coming into India, but in another 2-3 years, we will have a large number of personal vehicles in the market, which will be a big relief to the buyer. For the two-wheeler
Okay.
and three-wheeler segment, we have already crossed over the tipping point and the adoption is pretty quick. But there again, the opportunities which are there for the startups and the new companies are tremendous. I would say that the sky is the limit, and the open field has been provided for the companies to come forward and provide, make make the goal. So this is something which is there. The disruption which is taking place in the automobile sector and in the mobility sector is impacting the life too much. That's
Got
what
it. You made sure, Mr. Srivastava, you made an important point about how the Indian consumer is rather price sensitive. So bringing the price point lower is something that a lot of the OEMs are looking at. That's one thing. The other thing is range anxiety, right? Charging infrastructure is something that has also dissuaded a lot of people, or rather, the lack of the charging infrastructure has dissuaded people from switching to EVs. Do you think enough has been done on that front, and what more do you think the government can do?
The prices will come down automatically. The battery prices are coming down. The battery, which comprises about 35 to 40% of the price of the EV. And as we had projected, even it has come down from the $100 per kilowatt hour further down. So the prices are bound to come down, and they will come down quickly. And I mean, it's very clear. You have a better product. That is what you have to sell. That is what you have to pay, make the people familiar, and you have to sell a better product, which is extremely easy to my perspective. So the prices are certainly going to come down. Now the range anxiety, as I understand, is not really an issue because the charging speeds are going up, and there are fast chargers. A lot of research has gone into it. The fast chargers, there are chargers which charge a vehicle within 15 to 20 minutes of time. But yes, of course, if you want to charge it at home, then you have a slow charger, but you can always have a fast charger as well. So the charging range anxiety is certainly there because we have not been able to create the infrastructure, and that is where, again, the government has to have a policy where the government has to provide the proper environment for the startups to have the charging infrastructure all along the roads in the cities and the highways and everywhere for that matter. There are a large number of startups which have come up in the areas of charging infrastructure, those who are working, and they are, doing an extremely good job in the sense that announcing the things and taking up the thing, installing the charging station. But yes, it has not yet reached to the point where as a buyer, one would be comfortable in buying an electric vehicle. So that is
Correct.
something which is happening. And yes, the government needs to have the standardization for the charging protocols and then provide support for setting up the charging stations. That is very much needed, but it is a kind of a non-issue because the charging speeds along with that are also going up. That is also true.
All right, fair enough. Very valid points made there. We would have loved to chat some more. We'll do this at another time. Jay and Mr. Srivastava, thank you so much for joining us and putting the spotlight on, the Tesla, of course, the possibility of Tesla disrupting the Indian EV market and what the EV market could grow to from here. Well, for our stock markets, it's looking pretty good. Still holding actually with gains of almost 80 odd points. When we come back from the break, we'll get you excerpts from our conversation with the management of RHI Magnesita on their business going forward. Later, we'll also put the focus on chemical space in our segment Quarter Se Quarter Tak. Stay tuned.
Welcome back. Well, we started gap up, but from the highs, actually, we've come off considerably. So the high of the day is around 22,340 approximately. We've come off 100 points in the Nifty Bank. That's the one that's come off close to around 200 points as well. Well, let's focus on RHI Magnesita. I spoke with the global head, Mr. Stephen Borges, as well as India business head, Mr. Parmod Sagar. I started by asking them about their capex plans in the backdrop of Vesuvius going ahead and upping their capex to around 1,000 crores here in India. Let's listen in to what they had to tell me.
We are way ahead of the game, of course, because we've already spent a huge amount of money. If we take everything together that we're going to spend on the region here, it's around 450 million US dollars worth. I think, according to my calculation, this is about 4,500 crore. So this is the total package in the short term, but including what we have already spent. So we're way ahead here. We have now bought all the capacities that we need for the next years. We have still the need to build some capabilities now. So there's a lot of technology investments that we will do. We have a collaboration with a Japanese refractory company to build technologies and to bring this to India here. This is happening very soon. We're building up our iron making capabilities here, where we were not present until very recently. We are very much focusing on circular economy capabilities. So here, this takes a lot of infrastructure investments as well in order to bring this circular economy addition here. And we're, of course, leveraging the Indian IT capabilities, the IT capabilities of the country for two reasons. We're building programming capabilities, software capabilities, and we're bringing all the global services from all of our other regions to India in the next 3 years.
Okay, all right. So quite interesting. So $450 million is the ballpark number that you've laid out in terms of capex that you've spent, and what you're going to spend going ahead as well. So we got that point.
This is the money that we're going to spend.
Got it. And from here on, out of that 450 million, how much has already been spent and how much will be spent?
Yeah, about 80% is already spent.
80% is already spent. All right. So that's why you're saying that you're well ahead of the curve. Give us a few more details then. In India, the steel consumption is expected to grow in double digit, very, very roughly. Could you tell us what kind of growth do you see for your industry here in India? And if I go via revenue matrix, you'll have close to around 33% of the market share. Where do you see this number headed?
Well, the market share focus is not really the number one focus, but with the addition of the technologies that we will add in market segments in which we're not now in steel and also outside of steel. Okay. Not to be forgotten, refineries, cement, glass production, copper production, all this is growing in the region. Our market share just by default will grow to a little short of 40% in the next years. In India, on the steel side, we have to differentiate between steel production and steel consumption. We have a large percentage of imports into India still, especially from China. This will continue unless there are some drastic measures. Therefore, the steel production in India is around 6-7%. The production growth 6-8%, and this will be the growth of our business as well.
Got it. What about the export strategy? You'll have made this point that you're looking to get into markets like East Asia as well as Africa. I think currently the total exports are roughly around 11 to 12% of the total mix, and you'll want to take it to around 20%. What kind of progress are you making on that front?
Yeah, this is a very interesting question because we have to look at this from two perspectives. There's the outside-in perspective. 3 years ago, RHI Magnesita was importing 80% of its materials. Now we are already producing 60% in the country, so from 20 to 60, and this will go to 80%. Self-sufficiency inside India for India. On the export side, we have a very small export percentage of maybe 6-7%. 3 years ago. This is now at around 12%. This will go to 20% in 2025 and then to 30% in maybe 27, 28. Oh. So India will become a manufacturing hub, but not just for the region, but for the entire world.
Okay, got it. Quick counterpoint before we get to Mr. Parmod. As of now, the total royalty that is paid, I think, of the listed entity is around 2%. Your peer is Vesuvius. They pay close to around 3%. Do you see there's a possibility that there is a tweak in the royalty rates as well?
Well, it depends very much on where the technology comes from and how this develops. We don't have a royalty planning scheme. It's just a default from what will happen with the technology that we bring here. So it could very well increase slightly.
Okay, and we could hear that decision in the coming fiscal, that's FY25?
No, it's not a decision. This is a default of, it happens product by product, technology by technology. There could actually be some royalty income also if we develop technologies in India here later on.
Oh, interesting. So we'll see how that goes. Final question to you, Stephen. We have a big investor in there by virtue of the inorganic growth. The Dalmia Group has close to around 13% stake in the company. And reports indicate that maybe they could be looking at selling that. If that is true, would the parent be interested in picking up that stake? You'll have already pumped in some money, but that's the big overhang on the stock from an India market perspective. Your take?
Yes, they have always made it very clearly that this is not a very long-term investment. They are, of course, very intelligent and savvy investors, so they will do this in an intelligent way. So from an investor perspective, I think nobody should worry here. This will be block trade, so it won't be a real overhang for the stock. If the price is right, of course, as a group, we will always consider, but at the end of the day, of course, you need to ask our shareholder themselves of what they want to do.
Interesting. All right, Mr. Parmod, let's come across to you then. The utilization levels of both the acquired assets haven't really lived up to expectations. Give us a number. In the coming year, how do you see both these two acquisitions shape up? What is the rough utilization levels we could look at for FY25?
As of now, I think we are at about 60% level, and I believe in next 3 years we should reach to 75 to 80% utilization level.
For high tech as well as for Dalmia?
Yes, both.
All right. There was some refurbishment that you were taking on, particularly at Dalmia. What is the total money you have earmarked for that? And how is the progress out there? By when can we see the fruits of this particular investment?
First of all, this year we were trying to see how much is the low-hanging fruit without investing too much money. If we can leverage, we can improve our productivity, improve working conditions, and then invest money. We already started investing money, and I think in the next 3 years we will be spending something like 250 crores to 300 crores.
Okay, got it. Also, because of the consolidation in the refractory industry, I think you all have mentioned on your con call as well that it resulted in losing some kind of share from a client like, say, SAIL. What are you all doing to get this market share back?
Actually, earlier it was 3 companies, and Steel Authority of India is having tender-based system. So 3 companies was bidding for one particular tender. So now it is 1 company. So it was anticipated. We were aware that they're going to lose 2-3% of this business. But at the same time, we start working on how to mitigate that. What are the products which we are not selling to Steel Authority of India? We start trying those products in Steel Authority of India, and the results are very encouraging. And I believe we will be overtaking. If we are losing 3% business, maybe we will compensate that 3% and increase rather 1 or 2% more.
Okay.
That is not a concern.
Okay, final question before we let you all gentlemen go, Stephen as well as Mr. Parmod. Any more inorganic plans for the listed entity? You'll have done a fair bit on ground. Is there more inorganic plans? Do you all have the appetite?
Yes, we have the appetite. There are always inorganic plans.
So we could see more inorganic from the RHI listed entity here in India in the coming fiscal? Are you all on the prowl?
Whether in the coming fiscal, I can't promise, but for sure it's possible that this will happen.
All right, well, let's move on to our special segment now, Quarter Se Quarter Tak. Sonal is joining in to tell us everything that you can expect from chemical companies in Q4. Sonal, over to you. Thank you so much for that. Well, Q4 for chemical sector is going to see a sequential recovery. YY, however, will be largely weak. Dumping from China has continued due to lower demand in that region, which has continued to impact global realization. There are green shoots in certain end-user industries such as dyes, pigments and polymers as well. Now, this is for chemicals, but agrochemical demand continues to be under pressure. But is recovery in sight? Well, not in the near term. Kotak Institutional Equity says recovery remains elusive and expected to take at least 1 to 2 quarters. And Elas says that price recovery will take at least 2 quarters. Now for chemical companies, let's look at expectations. These are the estimates from Kotak. Aarti Industries is expected to see profit decline of 15% YOY, but it is expected to be up sequentially. For Atul, profit expected to decline 11% YOY, but up 17% sequentially. For Naveen Fluorine, PAT down 65% YOY, up 14% quarter on quarter. SRF should see PAT down 26% YOY, but up 64% sequentially. And when it comes to Tata Chemicals, profit is expected to decline 82% YOY and down 18% sequentially. So commodity chemical company here and soda ash prices, they continue to be lower. Vinity Organics, that will see PAT down 28% YOY, but up 8% sequentially. And the management did indicate to us that worst is over in terms of business fundamentals. Moving on now, for agrochemicals, no recovery will be seen. UPL, the biggest agrochemical company, will see a loss yet again, though losses will come down sequentially. Double-digit price erosion will be seen. PI Industries will be an exception as always. It is expected to see profit growth of 50% YOY, but that will decline 6% sequentially. Growth will be led by scaled-up revenues from new products. Let's leave you with the valuation picture now. It continues to remain elevated across names. Aarti and Atul with similar end-user profile trading between 41.6 to 46 times. We have SRF and Naveen Fluorine trading anywhere between 38 times to 48 times. Tata Chemicals trades at 28 times. Vinity Organics is 39 times. And PI Industries at 32.5 times.
All right, Sonal, thanks very much for that sort of comprehensive wrap out of what we can expect from the quarter. Let's get an analyst in as well. Ranjit from IIFL is with us to take us through, the expectations as they stand right now. Ranjit, good morning. Great to have you with us here. Prashant this side. So let's just start with, which parts do you think will see, as Sonal outlined, agrochemicals perhaps no real recovery expected, but to your mind, what's got the best chance and the fastest chance of a revival? And, on the other side, is it agrochemicals? Is it something else? Just sort of describe the spectrum for us, because chemicals is really many sectors there.
Yeah, Sonal has, first of all, thank you for having me on the show. Sonal has kind of beautifully put this. So if you kind of see the chemical sectors, the primary or the major user industries is AgChem, which is under a cyclical slowdown at this point of time. And here we have seen a significant pricing erosion that has been impacting the generic players. As far as the specialty chemical is concerned, the ones who have a contracting kind of a mechanism are still able to do well off. So the way we see it, if you look at probably we are calling it as an improvement and not yet a recovery at this point of time. We are also of the same view that it will take at least 2 quarters to kind of see a bit of a recovery in the sectors. At the same time, while we are seeing the valuation remain expensive, and that was kind of makes us a bit more cautious on the sector. 4Q will definitely see an improvement sequentially, because 3Q was really bad for the entire sector, where we have seen order deferrals. So 4Q, we will have those orders coming, bunching up, and then we'll see a bit of a seasonality hitting the sector. So that's how we are seeing it. 4Q will be a better off, but calling it a recovery is still a bit early. Probably we will still see a bit of an improvement. I think 1Q is what will give a bit of a flavor where this momentum is continuing or not.
Okay, all right. Hi, Ranjit. Good morning and good to see you. And we had the management of Vinity Organics, and they were sounding quite optimistic about the outlook. And managements, they're perfectly justified in sounding a little bit more optimistic, so good on them. But given that you as well are sounding that you're factoring in some kind of recovery from the next quarter onwards, which is the stock that will be top of mind focus?
So I don't cover Vinity actively, so to that extent, I won't be able to comment on that. Again, when it comes to stock-specific picks, as Sonal has kind of pointed out, the valuations are anywhere between 28 to 30 times, so that kind of caps upsides, at least in the near term. But since we believe the story is more structural, so to that extent, one can still wait for a bit of a correction and then enter. Again, here, coming to stock-specific, we have seen the likes of SRF has been doing well. Yes, there are a bit of a near-term headwinds, so probably one would be able to kind of tie through or see through that, and at a right price is what we'll again look at SRF.
Okay. What are the other stocks that you track, in this entire space where you're bullish on for the medium to longer term and you expect good numbers this time?
Yeah, on the stock specific, if you look at probably the valuations is what one of the key things. As I said, most of the names, we do have a structural positive. And if you look at the estimates, we are building in at least 30% CAGR from a 24 to 26, at least 2-year CAGR of 30%, which is a very strong number. So based on those numbers, when we see the valuation as 28 to 30 times, that do calls for a bit of a cautiousness, at least in the near term. once we'll start seeing a very strong recovery, that would be probably the right time to kind of go a bit more positive on these sectors. So the stocks which are probably a bit more compelling on the valuations is what we are a bit more positive on. So one of the stocks that we would like to highlight is an RHI Chemical, is still probably a low mid-teens kind of a PE, and there the story seems to be more structural, where we are seeing them from an main commoditized kind of a business. They are moving over to more of a value-add business. So probably that is what we continue to have a buy rating on.
That's that one, Arkin Chemicals, 685, your commodity play, but as you said, moving away from commodity to more specialized sort of chemicals. Value-added segment, and valuations are attractive, as you said. What else, Ranjit, if you want to highlight one or two more names?
Yeah, it's difficult, as I said, 28, 30 times. Valuations would definitely be what kind of restricts me from giving out any topics on this space. But as you said, this is more of a structural. Probably in a quarter's time, we will see that if things are started to return, we will definitely have more names. Yeah,
no, I mean, it's always difficult to buy just in time. So if it's about a quarter,
right.
So,
the thing is that if you look at even the global insights that we have been tracking, has been kind of expecting a bit of a recovery from the second half of this calendar year. But again, what we have seen that it remains a bit of optimistic, and we haven't yet seen any recovery in the prices. So that is what kind of restricts me to not to put out any names at this point of time. As we kind of again with more confidence, yes, there are a bit of the thing that we are tracking is the pricing action. And if you look at most of this pricing action are still kind of 20-30% down. So even if there is a bit of a volume growth in the sector, the pricing action is what will kind of limit the EBITDA growth. And that's where we still see a bit of a risk for FY25 and FY26 numbers. And that's what restricts me from putting out any names at this point of time.
All right, Ranjit, we leave it at that. Thanks a lot for joining in. Let's slip into a quick break. On the other side, Brent crude prices have fallen 3% last week. Some more discussion on that coming up. Manisha Gupta will join in to talk about that. Stay with us.
Okay, welcome back. A third of a percent higher off the highs, but 78 points on the index. Mitesh is back with us. Mitesh, not exactly giving up everything, but off the highs by a decent bit. What's the trade here on the index?
No trade, Prashant. So actually, The idea is that the reversal which happened on Friday kind of negated the downside possibilities, and we haven't got signals of the index moving on the upside. So one, I'll wait for the Nifty to either get past today's high of 23,337 or 23,340, or have an hourly close about 22,300 to take some long position. If that doesn't happen, then we'll just chop around in a range. So we're in kind of a wait and watch mode when it comes to the indices. On the stock side, though, I have a sell on persistent with a stop at about 37.55 for targets of around 35.60 on the downside. And the stock which I like, and disclaimer, we have a buy call here and recommended to our clients as well, is Hind Petro. That's a buy with a stop at about 490 and a target of roughly around 520 can be looked at.
Okay, by the way, if you're wondering why Persistent is down 4.5%, they had a conference call where their margin guidance has disappointed the street. They've spoken about how the guidance for the margins will be flat in FY25. And they also speak about how the next 12 months will be quite challenging in terms of a macro environment. But their goal is to maintain a top quartile growth while maintaining margins at current levels. So a little bit of disappointment coming through for Persistent Systems. Thanks, Mitesh, for joining in. Let's shift focus now to the commodity markets. Manisha Gupta is joining in. Manisha, what's the one commodity you're tracking today?
Well, there's one area which has continued to gain, and that has been base metal prices. And within that sector, it's copper prices holding around that 22-month highs. We have seen prices from a low of this year of $8,900 come up to $9,800 a ton on your screens. So we have seen prices gain up by 4% in the previous week, and it's 14% up in the last 1 month itself, clearly leading the rally there. And if you look at the copper as a barometer for economy, well, you have seen strong numbers come in for this one. The latest data today, the China holding loan prime rate steady, is something that the street was anticipating after the move that we saw, especially in the month of Feb. But there are various other reasons for the copper prices to continue to surge higher. There have been large capital inflows within the commodity. We have seen those reports of output cuts. Raw material shortages are key drivers, the reason that the prices have been trading on the higher side. Also, the green energy transitions has fueled the demand going forward. That is what the estimates are doing right now for the prices as well. The sentiment itself has been baked into the prices there. Demand from AI-related electric equipments, data centers has been on the stronger side. The street also is looking at China copper smelters, where they have pledged an output cut of 10% in 2024. The output cuts in various mines is something that continues to grow in sense of a list there. Zambia mines have been shutting output because of power shortages there. You have Panama's Cobre mine shutting down. South African mines have failed to meet their 2023 guidance itself. And various mines, whether it's Codelto and Antofagasta, have been cutting production in the first quarter of 2024 itself. And that is weaving its way in case of prices. Also, take a look at the kind of hedge funds and money managers long positions that have built in copper on the back of fundamentals. That is at multi-year highs as well. So there is a very bullish view going forward in sense of copper. Trafigura, which is one of the largest brokers of copper in the world, says that there is underinvestment and they do see a deficit of a larger quantities by 2025 and 2030 as well. There also are experts suggesting that 5 to 6 million tons of deficit is what you could see going forward. Demand in AI is also estimated an additional 1 million tons by 2030, and we haven't seen that kind of copper supplies come into the market. Add to that the kind of reports that we've been seeing from Citi and Bank of America talking about $10,000 a ton of copper in this year and an all-time high of $12,000 in the next year as well. That is what is keeping a lot of people interested and holding longs in this space.
Manisha, thanks very much for that. So copper is doing very, very well. Calls for bigger shortage into 25. We'll take a quick commercial break here. We'll connect with Sunil Vaswani, Executive Director, Container Shipping Lines Association India, Ajay Sahai, Director General and CEO at FIEO, to discuss the impact on shipping industry amidst the flare-up of tensions in the Middle East. Stay tuned. Welcome back. 100 points on the Nifty. Things are looking pretty good with an hour behind us this Monday morning. Now, the ongoing Iran-Israel conflict has raised concerns in the global maritime industry, causing supply chain disruptions. Shipping container rates have surged between 40 and 50% on a year-on-year basis. Let's talk about this more and whether this is going to worsen. Ajay Sahai is Director General and CEO at FIEO. Mr. Sahai, good morning. Great to have you with us here. Thanks very much for your time. I mean, that part of the world has been not on the brink, but it's kind of been seeing a bit of upheaval for the last year or so. And now, of course, the fact that Iran and Israel looked like they were coming directly in confrontational mode, perhaps has raised tensions. But the impact on freight rates, etc., Mr. if you can just sort of put this into context for our viewers.
So, in fact, for last 1 year or so, we are seeing huge challenges in the logistics, particularly after the Red Sea crisis. And we were hoping that Red Sea crisis may diffuse, but with the Iran attack on Israel and counter-attack, which has been reported by Israel, the situation has definitely aggravated, and it has resulted in some disruption of the shipping also. Shipping freight were already very much elevated. They are further expected to go up, and so has been the insurance. We are watching the development very carefully, because if Iran stops the Strait of Hormuz, probably we may see some impact on the global oil and gas prices, particularly on the LNG prices. Global oil prices have already moved up, and they are expected to go up further. On the logistics front, we are expecting much disruptions, and in fact, a lot of exporters, they have already delayed the shipments. Much of the shipment which were expected to go in the month of March, they have been now moved over to the month of April and to some extent to the May also. So it's extremely very worrying situation, and we are concerned with the development. We hope that the global diplomacy will prevail. The two sides will come to some kind of agreement so that there is ceasefire, and ultimately the situation can be diffused.
Okay, the situation can be diffused. But in the event that the Gulf of Hormuz is shut, right, there is this worry that if things escalate, then the Gulf of Hormuz will be shut. But if that happens, what do you think the implications would be? And what are the alternatives now?
In fact, if the Gulf of Hormuz is set up, I think the problem will be with respect to the LNG supply, particularly from Oman, because there is no other route available. For other countries like UAE and Saudi Arabia, they may be using the alternative routes. Maybe the Red Sea, if the Red Sea is not working, everyone is going through the Cape of Good Hope, but definitely it will increase the cost significantly. Secondly, as of now, the Strait of Hormuz, they deal roughly with 20% of the oil and gas cargo. Whether the other route will be able to accommodate that is also an issue. So in the given situation, we are looking into a northward movement in the prices of oil and gas. It may not impact India to that extent, because we have the option of increasing our imports from Russia. But I think the global oil and gas prices are all set to move up.
But the impact is largely on oil and gas, right? As you said.
Yeah.
Not on container shipping, etc.?
No, definitely container shipping, in any case, they are much elevated and they are expected to go up. We are worried about not only the cost, probably there will be much disruption in the shipping schedule also. In fact, just after the Red Sea crisis, the shipping schedule has got haywire, and exporter is struggling to provide the timely delivery, and much of them have already moved to the air shipment and air freight in the last 6 months or so have gone up to some destination like Europe by 400%. So this is extremely concerning. This is extremely dangerous trend, and we are hoping that it should not diffuse further. The world is just coming out of the COVID crisis. We have already suffered Ukraine-Russia war. There is a Red Sea crisis, and probably this is going to give a huge jolt to the global trade and the global economy.
Okay, so what is the impact that you've seen on Indian companies so far, both in terms of overall business as well as freight rates?
No, of course, because of the high freight rate, the bottom lines of the companies have been impacted, and so far exporters have been able to absorb that. The new contracts have been negotiated, and luckily both the sides have agreed to bear a little pinch of punch, and that's why we are not expecting exports to be impacted. But point is that if this escalates into a war, then the entire Middle East trade may be impacted, and Middle East is extremely important for us. Roughly 22% of international trade happen with the Middle East countries also. So we are just hoping that the Israel and Iran comes to some kind of conclusion and there is a ceasefire now, because if Iran further escalates it, or if Israel further escalates it, it will be huge blow.
Okay, we have Sunil Vaswani, who's the Executive Director at Container Shipping Lines Association, who is also joining in. Mr. Vaswani, thank you for joining the conversation. At your end, how are you reading this entire situation, both in terms of what the impact would be if this escalates, if the Gulf of Hormuz shuts down? What is the kind of cost escalation that we're looking at for the industry and for your own, for your own association?
Yeah, right. Morning and you. As things stand currently, the countries like Saudi Arabia and Egypt are already impacted because of the practical closure of the Suez Canal and the Red Sea and the Bab el-Mandab due to the Houthi rebels. Now, if this escalates, then you could have a risk of the Persian Gulf and the Strait of Hormuz also getting impacted, or practically closed for that matter. And if that happens, a country like Saudi Arabia will be particularly impacted because it will be shut on both sides. So supply chains will definitely be impacted there. And also in countries like the other countries of the Persian Gulf would have problems, and particularly as far as the imports are concerned of essential commodities like pharmaceuticals, foodstuffs, etc. Fortunately, as it seems that the response from Iran to the last Israeli attack has been rather muted, verbally muted, and there will be no further action on that. So that said, it gives some confidence that hopefully the situation will not escalate. But in the meanwhile, but if it does, of course, then even the oil supplies and all that will be impacted. But in the meanwhile, the insurance costs have already gone up as far as the shipping lines are concerned. The war risk premium earlier used to be 0.05% of the value of the ship. It has gone up to 1%. So for a vessel which costs about $100 million, which is quite common for a ship, in fact, most ships even cost more. Straight away, $1 million is the cost of the war risk premium that is applicable. And though currently the situation in the Persian Gulf seems quite okay, but it is quite clear that any vessel having the remotest of connection with Israel could be the target. Also, as far as the disruptions are concerned, one must bear in mind is that different sizes of ships and different configurations are available for different trade routes. And this constant disruption kind of, forces us to, interchange those vessels, and then getting the right size of the vessel or the right configuration operationally as well as commercially in a new route becomes quite challenging. As things stand, there has already been a certain amount of disruption as far as Europe and the US East Coast and Latin America are concerned because of the diversion over the Cape of Good Hope. Obviously, this has increased the cost as far as the capital expenditure is concerned, charter hire is concerned, feedering cost is concerned, crew cost is concerned, fuel cost is concerned, etc., etc. So, for instance, if on an earlier leg, same leg to Europe, if you were operating via the Suez Canal, a service with about 9 ships would take 63 days for a round trip. Today, going over the Cape of Good Hope, you need to add 3 more ships to be able to maintain that schedule, which is a weekly schedule, which was originally a weekly schedule. And that round trip takes 87 days. So what is happening is that we are putting in additional capacities, which is costing us additional capital expenditure. Also getting ships, at such short notice with frequent disruptions is quite a challenge, either internally through your fleets or through chartering from the market outside, and the charter cost goes up. And eventually what happens is that, and one last point, that like for instance to the point that's happened to Europe that we are talking about is also some of the ports that were earlier serviced directly, particularly to the East Mediterranean ports, those are now transshipped by feeder vessels. So the feedering cost goes up, and of course the transit time increases. But the good side of it is that we've tried to shorten the trip for those direct vessels, So which means to North Europe, your transit time improves by about 5 to 7 days. So these are the kind of technical things that one has to manipulate with these frequent disruptions. Thank you.
All right, we're out of time, but fascinating always to talk about global shipping and the complexities of it. Mr. Vaswani, thank you very much for joining us. Mr. Sahai, it's a pleasure. And let's hope, fingers crossed, that things don't flare up once again and they quieten down and get better going forward. But I think we have to also sort of be cognizant of time here. We're completely out for now. 90 points is what the Nifty has got, 22,235. And it's an up-looking market, but it's off the highs by a decent bit. Market breadth, by the way, is still very strong, almost 4:1 in favor of advances. So the broader market doing much better as compared to what the index stocks are doing. But more is coming up. It's a wrap on Bazaar here from Sonia, Nigel, me, everyone on the team. Goodbye. But Chartbusters will pick up on all the action in just a bit.
GSPL slides 20% after PNGRB cuts tariffs for the company's key HP pipeline network. PNGRB tells CNBC-TV18 that it is only an adjustment in tariffs and not a cut. Meanwhile, GAIL too comes under pressure after the PNGRB adds that there would be revision in tariffs for GAIL as well.
Oil marketing companies HPCL, BPCL and IOC, they surge on the back of softer crude oil prices. Brent trades around $86 a barrel as geopolitical issues ease out a bit.
Hindustan's zinc climbs nearly 5% after reporting an inline set of numbers in the fourth quarter. The management tells CNBC-TV18 they expect the cost of production to dip towards $1,000 per ton. Also add that there was no fresh proposal